Hello and welcome to the first edition of Tax News, the place where we intend to bring latest news and development in the area of taxation to you. This is the first edition of Tax News, and we do expect to receive your feedback in terms of how it was, what you would want us to cover, and the frequency of this thing. In this edition, we are going to cover two cases which have come in this week relating to income tax. Other things will follow on a regular basis. So if you want to stay tuned in this particular aspect, do follow us on LinkedIn, subscribe to our YouTube channel, or follow us on our Twitter handle. All the links and description will be given towards the end of the video. For now, let's look at those two case laws that we are covering today. The first case law is basically relating to capital gains under Section 50C. And this case is given by the Raipur IIT in the case of Pramantha Ranjan Baswas. Now, just to give you a background, 50C basically deals with substitution of the guideline value for stamp duty against the actual consideration if that guideline value is higher than the price at which the property is bought or sold. So in this particular case, the issue was for the purpose of calculating these capital gains, what would be the date when the stamp duty value will be taken? Is it the value on which the agreement to sell was done? Or is it the value on the date when the actual sale date was executed, particularly when there was a time gap between the two of these things? Some of the relevant facts which were considered by the tribunal while arriving at the decision was that on July 2010, the consideration for land was fixed amongst the parties and even the payment was made. The agreement to sell was entered and the possession of the land was given to the buyer. However, the registration of the sale deed was done on 24th of March 2012. The decision which was given was that in the facts which have been given, the property actually was handed over to the buyer, right? The possession was given, the consideration was fixed. Only thing that was pending was the registration. So the decision that was given was that the stamp duty value on the date of agreement and not the date of sale is to be considered for the purpose of calculating capital gains under Section 50C. Let's move on to the next one, the second case that we have, and this relates to interest earned by a company during pre-construction period. Now, we all know that any income earned by a company is taxable, whereas a capital expenditure, on that you are allowed a deduction. In some cases, what can happen is that the company may not have commenced business operation, but during the construction period, it has certain deposits with the bank or certain other income which accrues to it. The question is, should such interest income be reduced from the cost of fixed assets or should be considered as an income from other sources? Now, there are different decisions on this particular aspect. We are not getting into the merits and demerits of those. For our current purpose is to bring the news to you, and therefore what has been held here is what we are discussing. This case is from the Delhi IIT in the case of Vatika Hotels Private Limited. Now, if we go to the facts, the facts were that Vatika Hotel was constructing a hotel, and for that purposes, there were various suppliers from overseas. Vatika obtained certain letter of credits and bank guarantees for which it had placed certain fixed deposits. The issue was whether the interest on such fixed deposits, which were made to obtain bank guarantee or letter of credit, was to be taxed as income from other sources. The facts I've already told you. The decision was that such an income is a capital receipt and should be reduced from the cost of the project. Now, the key reason which seems to be behind this particular reason is that whenever any income is earned from activities which are inherently relating to the construction process, those should be reduced from the cost of acquisition. Now, in this case, the supplier was supplying products for construction purposes. In order to secure those projects, those fixed deposits were kept, and the interest income was ancillary to the entire construction project. It was not a separate business activity. Now, there are case laws where, even interest income on surplus fund has been held to be taxable as income from other sources. But we are not going into the details of those case laws for now because, like I mentioned, the purpose here is to just update you in terms of what's happening. A contrary view or otherwise is something which may also be available. And if any one of you want to come out and support us on those particular view, want to figure on this channel, we'll be more than happy to have you on board. Like I mentioned, this is the first edition. We do feel that your inputs and feedbacks on this particular thing will help us improve it. If you want, you can go to our website, sortingtax.com. A lot of resources on blogs on in taxation are something that you can find there. You can follow us on LinkedIn, Facebook, or Twitter. All these places we are available, and we'll be happy to have you on board. Until the next edition of Tax News, thank you very much for watching.